Okay, hi there, and welcome to a micro video. And in this session, we're going to spend a few minutes thinking about the kind of A-star evaluation points that you can build into your longer essay answers, or perhaps the longer questions in a daily response. Our focus is going to be on market structures and saying some pretty fundamental points about the types of markets shown here. Thames Water, a utility monopoly; Netflix, a contestable oligopoly; Uber, challenging the hegemony of taxi driving companies; Amazon, pretty ubiquitous around the world these days; and businesses such as Airbnb. Quite important to argue that actually the conduct of businesses, what firms do in a market, has a big impact on different types of economic efficiency and economic and social welfare. I think it's quite important to judge the outcomes in a particular industry on a case-by-case basis, not automatically assuming that what the textbooks say might actually happen. So I want to talk just for a few minutes about market structure. So many of you will be revising your market structures: perfect competition, monopolistic competition, oligopoly, monopoly, and contestable markets. So whenever you get a daily response question, for example, think about, well, what's the market structure? How many firms are there in the industry? How highly concentrated is the industry? Are you asked to do a concentration ratio calculation, for example? How differentiated are the products, the goods and services? Are the barriers to entry and exit significant in a market, including legal barriers such as patents and franchises and things, structural barriers, cost advantages? Is the industry regulated, unregulated, or perhaps self-regulated? Crucially, what's the nature of the supply costs? How big are the economies of scale, internal scale economies? Where's the minimum efficient scale relative to the market size? Are there some big sunk costs which can affect contestability? What's the price elasticity of demand for different products? Does it vary by segment between different types of consumers? Because that then allows price discrimination to take place. How cyclical is the industry? What's the income elasticity of demand for the product? And crucially, not just on the supply side of the market, but think about the number of and the power of buyers. So monopsony power has become pretty big and pretty mainstream in economics exams in recent times. Now, crucially, market structures influence the behavior of businesses. And the other point to note is that market structures are dynamic. They change because of things like regulatory reform, changes in technology, and other external factors, including globalization and trade deals, for example. So market structures most of the time are pretty dynamic. And that's why exam boards like to choose industries where things are happening, both on the demand and the supply side. And then you can say some useful things about the impact on different stakeholders. So market structure. My second point, when you think about these kind of industries, I mean, the poster child, if you like, of the modern day markets, is about the conduct of firms. Now, the conduct basically means what firms actually do. So think about different pricing strategies. Are you familiar, ahead of the exam, with limit pricing? Are you familiar with price collusion in an oligopoly? Are you familiar and confident with price discrimination? These are separate topics worth really getting a hold of. So pricing strategy is conduct. Investment decisions. When you draw those diagrams showing a firm making a chunky supernormal profit and you label it nicely, don't just leave it there. Think about how the profit is used. Is it used to fund investment or research and development? Does the business pay tax on those profits? Market entry and exit decisions, the shutdown point for some firms that are struggling, whether firms decide to enter a market and turn the threat of competition into reality. In some markets, for example, monopolistic competition and oligopoly, we have a heavy reliance on non-price competition, where firms spend lots of money on marketing and other forms of non-price competition. In the labour market, what are the key decisions about how many people to employ and what wage to pay? And big issues, big social issues about the extent of ethical or unethical behaviour by businesses. The contemporary issue about tax avoidance, particularly for transnational corporations. So when we say conduct, we mean the conduct of firms is what they actually do. And a key evaluation point is that the conduct or the actual decisions of firms is strongly influenced by their objectives. Are they profit maximizers? Unlikely. Are they revenue maximizers? Are they growth maximizers? Are they social enterprises? Are they state-owned businesses with political objectives as well as commercial objectives? So the conduct of a firm is strongly influenced by their objectives. The conduct of firms, the behaviour of firms, is also shaped and affected by the regulatory environment. So a price cap, for example, or a regulator who insists on certain standards of service. And also by the ownership of a business. Is it state versus private sector ownership? Are the shareholders activist and transparent in holding management to account? So-called principal agent problem. So when you get a question on market structures, look to see if you can say something about the actual conduct of firms, what they do. Because, and this leads me on to my final section, the conduct of a firm in a market has an impact of these types of firms. What Netflix decide to do, how Uber behaves, what Thames Water does to the water bills, how Amazon operates as a business. The conduct of these firms impacts on performance. What we mean by this, we mean performance is efficiency. I've said in videos before, in an A-level micro paper on market structures, you cannot go wrong if you link what you're doing, what you're talking about, to one or more types of economic efficiency. Allocative efficiency, price and marginal cost. Productive efficiency, long-term cost. Dynamic efficiency, innovation, choice, and much else besides. So performance is about whether the market achieves efficient outcomes. Performance is about whether the market is good for overall economic welfare, including consumer surplus, including the affordability of goods and services, and very importantly, equity in access. This is incredibly important. A lot of issues these days to do with inequality and whether people can afford basic important goods and services. Widen the whole debate out. What's the impact of firms on social welfare? Are they meeting their environmental challenges? Are prices falling in real terms? Is productivity going up? Is the firm making enough profit to drive future investment? So there are quite a few performance indicators. And again, the conduct of firms, what firms choose to do, has a large direct bearing on market performance, and in particular, whether scarce resources are allocated in an economically and socially efficient way. So just a few sort of evaluation points really around this. Again, I think crucially for A-star, look for evidence on the actual conduct of businesses rather than just assuming a textbook answer. A lot of students literally dump diagrams into their answer without really thinking whether it's relevant or not, or developing the diagram in some shape or form. So think about the analysis diagram you're using and how you can then link it in the text of your answer. But look if you can for evidence on conduct of firms. In the data response paper, can you find some evidence perhaps of prices and profits, etc.? One or two other points to finish with. The world is changing. Digital businesses, we know, because many of you are consumers of them, digital businesses can scale very quickly. They can go from zero to scale in months, if not years. Uber, Airbnb, Netflix, they're great examples of businesses which have scaled remarkably quickly and are now challenging the market dominance of firms that have been around for decades. This raises obviously important competition issues, which often the exam boards like to test. And then there's this wider issue of sustainability. When you're assessing market performance, are businesses on their own or collectively doing enough to meet the needs of the age as we reach this critical inflection point vis-a-vis climate change? My last point is really, hopefully, something that chimes with some of you, that no business operates independently. So we tend to associate interdependent behaviour with oligopoly, and that's fair enough. We can use game theory to explain that. But actually, all businesses are interdependent to a degree. They have to think about the likely reaction of the rival firms or the potential competitor businesses. So it's important, I think, to recognise that interdependence, particularly in a world of complexity, particularly in a world of globalisation, where lots of markets are becoming more open through trade and investment to rival suppliers. It is a great idea ahead of the papers. Make sure you've done a bit of revision on the basics of game theory, why firms collude, why collusion breaks down, why firms compete in certain ways. Please make good use of game theory in your answers. This is the stuff of really high grades. Hey, good luck as you head into the final few days of revision. I'll be doing some more topic videos and essay plans. But I just wanted to take you through my thoughts on market structure, conduct and efficiency, because these three are very strongly linked. Thanks a lot.